Hello everyone and welcome to Financial Accounting. In this video, we will see how closing entries are recorded. We discussed temporary and permanent accounts, as well as closing the books and preparing financial statements in the video, The Accounting Cycle, Reporting Financial Results. If you haven't had a chance to watch it, the link is right here and in the description box. Closing entries are usually prepared at the end of company's accounting period when financial statements are recorded. If an accounting software is used, the closing entries are automatically prepared at the year's end when the year is closed. Closing entries reduce the balance of all temporary accounts to zero. The temporary accounts are also called nominal accounts. Temporary accounts include revenue, expense, income summary, and dividend accounts. Temporary accounts gather data related to one period. That is why closing these accounts is important to determine the net income or loss for this period accurately and to adjust the equity balances. Permanent accounts include assets, liabilities, and stockholders' equity. It is important to note that closing entries only reduce temporary account balances to zero, not permanent accounts. Permanent balances are balance sheet accounts and are not closed as they accumulate data from period to period and represent a company's financial position. To prepare closing entries, all of the revenue and expense account balances are transferred to a clearing account called income summary. Remember that you won't see the income summary account on financial statements as it is only used to prepare the closing entries. Once all revenues and expenses are closed to income summary, its balance will represent net income or loss for the period. This amount of net income or loss is then transferred to an equity account. Dividends are not closed through the income summary account because they are not expenses. Dividends are a portion of a company's earnings that it returns to shareholders. They are directly closed to equity. Note that for a corporation, the owner's equity account we use is retained earnings. For proprietorships and partnerships, it is capital accounts. Once the closing entries are posted to the ledger accounts, also called T accounts, companies prepare a post-closing trial balance. This trial balance will only include assets, liabilities, and owner's equity accounts. Note the accounting equation here. Assets are equal to liabilities plus owner's equity. The purpose of this post-closing trial balance is to verify if the closing entries have been properly journalized and posted. Total debits must be equal to total credits. Let's now look at an illustration to see how closing entries are recorded. Take a look at the information regarding the account balances of Johnson Corporation. We will prepare the necessary closing entries from the given account balances. Cost of goods sold, $200,000. Freight out, $7,000. Insurance expense, $12,000. Rent expense, $20,000. Dividends, $5,500. Salaries and wages expense, $61,000. Sales returns and allowances, $15,000. Sales discounts, $8,000. Sales revenue, $350,000. Let's quickly review the rules of debit and credit for revenue, expense, and dividend accounts. Revenues are increased by credit and decreased by debit. Expenses and dividends are increased by debit and decreased by credit. The first step in the closing process is to close all revenue-related accounts to income summary. For Johnson Corporation, revenue-related accounts are sales revenue, sales discounts, and sales returns and allowances accounts. Note that sales discounts and sales returns and allowances accounts are contra revenue accounts, and their normal balances are debits because they reduce revenue. We will also close the contra revenue accounts to income summary along with sales revenue. Sales revenue has a normal credit balance. Therefore, we will debit it for $350,000 to close it. I will use the Excel formulas to make sure there are no typos. If you are not familiar with Excel formulas, all you need to do is enter the equal sign and then click on the cell with the number you need to use in the formula. Sales returns and allowances is a contra sales account and has a normal debit balance. Therefore, to reduce its balance to zero, we will have to credit it for $15,000. Likewise, we will close the sales discounts account by crediting it for $8,000. We will credit the income summary account for the remaining balance, which is $327,000. This number represents net sales. The balance of the net sales is calculated as sales revenue of $350,000 less $15,000 of sales returns and allowances and less $8,000 of sales discounts. The formula is equal sign G13 minus H14 and minus H15. This entry reduces the balance in revenue and contra revenue accounts to zero and prepares them for the next accounting period. The second step in the closing process is to close all expense accounts to income summary. Expense accounts have a normal debit balance, and that is why they must be credited to reduce their balance. To close the cost of goods sold account, we will credit it for $200,000. Likewise, we credit freight out for $7,000, insurance expense for $12,000, rent expense for $20,000, and salaries and wages expense for $61,000. We will then debit the income summary account for the total of all expense account balances. I will use the sum function to calculate the amount of the income summary in this journal entry. The sum function adds value. You can add individual values, cell references or ranges, or a mix of all three. First, select the cell. In our example, it is G19. Type the equal sign, then sum, then open parentheses. Select cells to add. We will add cells from H20 to H24. Type close parentheses and press enter. After all revenue and expense accounts are closed, the income summary account balance represents net income or net loss for the period. When closing revenue-related accounts, we credited income summary for $327,000. To close the expense accounts, we debited income summary for $300,000. Therefore, the closing balance in the income summary account after these two entries will be $27,000. Since the credits to income summary are more than the debits, it will have a credit ending balance. A credit balance represents net income. In the third closing entry, we will transfer the balance in the income summary account to retained earnings. Since the income summary account has a credit balance, we will debit it and credit retained earnings for $27,000. This will increase the retained earnings balance. Remember that net income increases retained earnings and owner's equity, and net loss decreases retained earnings and owner's equity. Now let's close the balance in the dividends account. Dividends balance is not closed through income summary account, as it is not an expense and doesn't affect income for the period. In our example, dividends for the year amounted to $5,500. To close this debit balance, we will credit dividends and debit retained earnings for $5,500. This will reduce the retained earnings balance. After the closing entries are journalized and posted, all temporary accounts will have a zero balance. The balance in retained earnings will represent the accumulated undistributed portion of the company's earnings at the end of the year. A post-closing trial balance is then prepared to check if the company has properly journalized and posted the closing entries. That's all for today. Thank you for watching this video. I hope you found it helpful. Don't forget to like and subscribe so you don't miss future videos. I will see you soon.